Chapter 2. Tax Games for the Wealthy. If you want to understand how the system tilts, start with taxes. On paper, Canada's tax structure looks progressive. Higher income, higher rate. Simple, moral, balanced. But once you look past the marketing, you see the real story. Not one system, but two different games with two different rule books. One rule book is for employees. The other is for people with assets, corporations, lawyers, accountants, and time. If you're an employee, your taxes come off your paycheck before you ever see the money. Every dollar you spend is taxed again. Maybe you claim union dues or a charity receipt. Maybe you get a small refund if the stars align. But if you're wealthy, if you're incorporated, if you own rental properties, if you have investments, advisors, or a holding company, you play by a completely different set of rules. The double standard built into the system. Let's imagine two Canadians, both making $70,000 a year. Person 1, a teacher, paid as an employee. Taxes taken off automatically, limited deductions, little flexibility, income taxed at full rates. Person 2, a consultant with a corporation, can write off meals, travel, vehicles. Claims a home office, deducts cell phone, laptop, conferences. Pays themselves a combination of salary plus dividends. Leaves profits in a corporation at lower tax rates. Defers tax for years. Same income. Completely different outcomes. This isn't a loophole. This is policy. Capital gains, where the system shows its true colors. If you work for a wage, every dollar is taxed at your full marginal rate. But if your money works for you, you pay half. Capital gains continue to receive preferential treatment, with a 50% inclusion rate on the first $250,000 of annual gains for individuals, and a 66.7% inclusion rate on gains above that threshold, and for corporations and trusts. In real terms, if you make $100,000 in wages, you're taxed on $100,000. If you make $100,000 selling stocks or other capital assets, you're taxed on $50,000. If you make $100,000 selling your principal residence, you're taxed on nothing. Work is taxed more heavily than wealth. Labor pays full freight. Speculation gets a discount. It's like the government saying, if you gamble on property, we'll reward you. If you teach kids, drive a bus, or work retail, sorry, full price. Real estate, the crown jewel of tax advantage. Canada's housing market wasn't just allowed to explode, it was designed to. The Principal Residence Exemption, PRE, allows homeowners to sell their homes for unlimited profit. Tax-free, as long as they lived in the property. If you're a renter, nothing. No deductions, no credits, no help. We treat housing like shelter for the poor and like a tax haven for the rich. And people who understand the rules take full advantage. Real estate and the tax system. Two different rules. The Principal Residence Exemption creates a significant structural asymmetry in how Canadians are taxed depending on how they hold wealth. When you sell investments, stocks, bonds, a small business, the profit is a capital gain, and you pay tax on half of it at your marginal rate. When you sell a designated principal residence, the entire gain is exempt. No limit on the amount, no minimum holding period specified in the exemption itself. The practical result? A dollar of profit earned by selling a home is treated more favorably than a dollar earned from selling almost any other asset, and vastly more favorably than a dollar earned from working. In real terms, if you make $100,000 in wages, you're taxed on $100,000. If you make $100,000 selling a home under the principal residence exemption, you're taxed on nothing. The exemption was designed with a legitimate purpose: to protect Canadians who had spent their lives building equity in a modest home from being taxed on the inflated nominal gains of a rising housing market. That protection is real and worth preserving. The question the system has not answered is why the same provision applies equally, regardless of how the property was used, how long it was held, or how large the gain. We treat housing as shelter for the many and as a tax-preferred asset class for those with the resources and knowledge to use it as one. That is not a housing policy. It is a wealth policy operating quietly inside what most people assume is a neutral system. The menu the wealthy use. Here's what accountants routinely recommend to wealthy clients. Incorporate, pay less tax on business income. Split income with family members. Claim a home office deduction. Write off vehicles, meals, phones, travel. Use holding companies to move money quietly. Defer tax for decades. Convert income into dividends. Shelter profits using trusts. Shift money to jurisdictions with advantageous treaties. Nothing illegal. Just not available to employees or the uninitiated. The sign and the spreadsheet. When a tax professional tells you that incorporation is just smart planning, they are telling the truth. Within the current rules, it is. But this is the greengrocer's sign in action. We perform the smart planning because the system rewards it, while pretending the resulting $20 billion a year hole in the public purse is a revenue problem we can't solve. The two rulebooks aren't a collection of crimes. They are a collection of choices. We have chosen to tax the person who cleans the hospital at a higher effective rate than the person who flips the debt that funded the hospital. We can choose differently. The charitable halo trick. We love to imagine charity as noble. And it often is. But for many wealthy donors, charity is also strategy. A billionaire doesn't donate cash. They donate shares. When you donate shares, you avoid paying capital gains tax on the increase in value. You still get the full donation credit. You reduce your taxable income. You gain public praise and influence. It's a 2-for-1 deal dressed up as generosity. The culture that justifies the system wealth privilege isn't just a set of tax structures. It's a worldview. In 2023, Australian property developer Tim Gurner said something so blunt it stripped away every polite fiction about how the wealthy view workers. Speaking at the Australian Financial Review Property Summit, he said, "We need to see unemployment rise. Unemployment has to jump 40 to 50% in my view. We need to see pain in the economy. We need to remind people that they work for the employer, not the other way around." That wasn't a slip. That wasn't a misquote. That was clarity. To people who benefit from the wealth-first system, workers aren't people, they're labor inputs. And economic hardship isn't misfortune. It's a management strategy. When the wealthy openly call for mass unemployment to discipline the working class, you begin to see the tax code for what it really is. A tool to entrench power, protect wealth, and keep workers insecure enough to accept it. Why tax games matter. The consequences are structural, not incidental. When work is taxed more heavily than wealth, inequality grows, not through any dramatic event, but through the compounding of small advantages across decades of working lives. Social mobility shrinks as the gap between earned income and inherited capital widens. Public services, deprived of a revenue base that could have been broader, weaken. Housing becomes unaffordable, when the tax system treats residential property as a preferred investment class. Social trust erodes when people sense, correctly, that the rules apply differently depending on what you own rather than what you do. And when that erosion runs deep enough, democracy itself becomes unstable. Because democratic legitimacy ultimately rests on the belief that the system is, however imperfectly, trying to be fair. Power and accountability. Power follows the tax code, and it gets there. Slowly. The capital gains preference was introduced with a genuine rationale, encouraging long-term investment. The principal residence exemption was designed to protect families from being taxed out of modest homes. Corporate structures existed to support small business. Each provision had a legitimate origin. But each one, over decades, was found by those with resources, refined by professionals, extended by lobbying, and protected from reform by the same concentrated influence that benefits from it. No single actor designed the whole. But the direction of the pressure was consistent. And consistent pressure over decades produces the same result as design. The people with resources shape the tax code to advantage capital over labor, then hire professionals to ensure it stays shaped. Everyone else pays full freight on every paycheck and absorbs the service cuts required when enough wealth has been sheltered from the public purse. This is guided drift in operation. Active pressure over decades, producing a passive-looking result. Canada doesn't have a revenue problem. Canada has a distribution problem. We generate enough wealth. We just don't collect it from the people who have the most ability to pay. The people who work the hardest pay the most. The people with the most options work the system, and the system rewards them for it. A note on complexity and choice. Critics of the arguments in this book will rightly point out that tax policy and public service delivery are immensely complex. They will argue that preferential tax rates for capital gains are necessary to encourage investment and risk-taking in a small, open economy like Canada's. They will argue that the principal residence exemption is the only way many families can afford to retire, or that P3S are the only way to get infrastructure built when government debt is high. These are legitimate policy arguments. They are the rationales referenced throughout these chapters. But here is the distinction. For 40 years, our public conversation has been dominated almost exclusively by those rationales. We have been told that the only way to have a functioning economy is to prioritize the mobility of capital over the stability of labor. This book does not claim those trade-offs don't exist. It claims that for 4 decades, the trade-off has consistently landed on the same side of the ledger. When complexity is used as a shield to avoid discussing who actually benefits from the drift, it isn't analysis. It's a performance of neutrality. This book was written to center the side of the trade-off that is usually left in the hallway.